The message then from Fed officials that yes, the economy is improving, but they're not looking at forecasts. They want to see the real data. And by the way, the metrics in terms of that policy function from the Fed will not be changing in terms of that interest rate hikes or changing in terms of their support and their QE program. And rate hikes not on the cards until at least 2023. That has been the consistent measures from Fed officials. The first test really coming this week then with the inflation data out of the US. Are markets now aligning themselves, and do they have greater confidence in the views of the Fed? Has that communication started to work for markets? Can they look through this inflation spike that we're expecting to get this week?
Well, I think the markets have found it very difficult to buy into the Fed's dialogue and narrative. I mean, we've had sequences and series of failed Treasury auctions from the 5 or 7 years onwards, pretty much for the last quarter. So I think it's been extremely difficult for the long end of the market to buy into the Fed extending this monetary policy for much longer than 2023. I think the second thing is that you do have an inversion of the US break-even inflation curve. So yes, the front end does buy into the fact that the Fed is going to be responsibly irresponsible in allowing an inflation overshoot, but that will pretty much end sometime in 2024-25. So yes, we've got a short period of very extraordinarily loose policy, but then it looks like we're going to ratchet up on rate hikes through 2023, 2024. So, you know, it's not going to be a pretty pleasant place to be towards the end of 2022 in equity and risk assets.
In the short to medium term, does the S&P 500 keep pushing higher, Sean?
Well, I think the reality is that you've got a sequence of a sort of honeymoon period now for equity markets. You've got very strong global growth. You've got very, very relaxed monetary conditions in the United States. You have one of the fastest accelerations in share buybacks in US financial history. And of course, earnings numbers now broadly are much better than what was expected 6 to 9 months ago. The only thing that will upset the equity markets, from my point of view, is if the corporate tax plans by President Joe Biden actually come through. So a minimum effective tax rate of 21% would be pretty difficult for the S&P 500, currently what's being priced in at the moment.
And what does it mean for the rest of the world? Because we started out this year, Sean, with growth as in the sort of global context. You know, 4 months on, it seems like that seems to be only a U.S. story. You look at India, you look at Brazil, the virus situation there. Yes, China, you have a base effect. So talk to us about new ones now.
Yes, I think the nuances are going to be that there are going to be economies, and you've mentioned 2 of them in emerging markets, which have found it very difficult to roll out a successful vaccine program. I would also add that Europe is extremely benevolent towards a decent summer season for the hospitality and tourism industry. So there are some wild cards here in terms of the fact that the growth rates don't materialize outside of the US. I would, though, add that paradoxically, the good economic macro news in China that's been seen pretty much over the last quarter has not got reflected in share prices. So there's been a big disparity between the relationship between share prices in the US and macro data and the share prices in China and macro data, which on the latter side has actually been very good. So again, there's a possibly pretty good period for Hong Kong shares versus the rest of the world over the next 2 quarters.
And since you mentioned it, does this certainty now over Alibaba, does that unlock, Chinese equity markets?
I do. I think part of the problem for the Chinese domestic markets and to some extent Hong Kong has been the regulatory overhang, both by the anti-monopoly and also by the PBOC, which has become perhaps overzealous in trying to burst potential bubbles or trying to restrict money into potential areas that might later on flare up as a systemic risk. I think to some extent that's now been removed, the overhang has been removed for the e-commerce giants. Bear in mind the bigger picture, which is that the PBOC wants to roll out its digital currency. The intermediaries that use that the most are the e-commerce giants. And in an international perspective, really the e-commerce giants have got an ability now to do cross-border transactions, and that in itself will help disintermediation of the RMB longer term.
Yeah, the longer term picture there. In terms of the near term, are you seeing any catalysts for the Chinese markets, Sean?
It's a difficult one because the markets are somewhat beholden to quite irrational, perhaps, or esoteric changes by the authorities are not necessary to macro data. So the disparity between real estate and the real estate shares, disparity between the material prices and chemical prices in China and the chemical shares are the widest ever, and also the widest divergence between them and the US. So I think we are certainly seeing fund flows, a slight capitulation towards China at the moment, but I think that's the wrong thing to be doing. We're going to get over this inflation hump, this spike in China, and I think after that, the authorities will have a much more relaxed attitude to the financial markets.